afternoon and welcome. I'm Brooke May, one of the managing partners here at Evans May Wealth, and we're excited to have you join us today as we dive into the fascinating world of digital currencies, blockchain technology, and the future of finance. Whether you're a seasoned crypto enthusiast or new to the topic, we promise that the webinar will provide valuable insights into this rapidly evolving space. I'd like to introduce Emily Palmer. Emily is a certified financial planner for Evans May Wealth who assists us in navigating all things planning. I'll now turn it over to Emily.
Thank you, Brooke. A quick note, this webinar is being recorded and we will post the replay on our website, evansmay.com. To begin, we are delighted to introduce you to our esteemed guest speaker, Jack Manley. He's a global market strategist at JP Morgan Asset Management. He's a frequent guest on BNN, CNBC, and Fox Business, where he offers up-to-date market and economic commentary. Today, he integrates his market and economy expertise with the ever-evolving space of digital currencies. If you have questions for Jack during the webinar, please enter them using the Q&A feature that you can find by hovering over the bottom of your screen. We will have time at the end of the webinar for Jack to address your questions. Without further ado, let's get started and welcome Jack to the virtual stage. Jack, thank you for joining us.
Okay, well, thank you very much, Brooke, Emily, both for the introduction and, of course, the invitation. Thank you, everybody, for taking some time to dial in today to talk about a somewhat prickly subject, right, which is the world of cryptocurrency. And I titled this presentation, Understanding Cryptocurrency, because I feel like while we talk about this stuff a whole lot, and it kind of ebbs and flows in terms of relevance and sort of popular discussion, not all of us actually understand what that word cryptocurrency means and what the implications may be for us as investors. So the mission, so to speak, of this presentation is to unpack the world of crypto, talk about those things that we actually need to understand as we are looking at this new, exciting, and rapidly changing asset class, and then perhaps talk a bit about the investment implications and sort of the what's next for the world of crypto. If we could push forward, not one slide, but two. The first slide on here is just going to be look at my team and who's responsible for this material. We can start by first talking about what the heck a cryptocurrency actually is, right? How do we define cryptocurrencies? And so what we've done on this page is sort of highlighted a handful of differences that are important to point out between cryptocurrencies and other currencies in this case mostly being fiat currencies, right? Currencies that are not necessarily backed by a specific This is going to be something very similar to the US dollar, the euro, the yen, the franc, the yuan, whatever it may be, right? So cryptocurrencies versus those traditional kind of fiat currencies. Now, some things that you need to know about cryptocurrencies is that unlike fiat currencies, they are not issued by any sort of centralized government, nor is the value there based on the confidence of the issuer itself, right? The value of the dollar is based, at least in part, on how confident you are in the state of the U.S. economy and its ability to pay its debts. That is not what's going on in the crypto space. It is also not secured by third-party intermediaries like banks or even governments. Instead, it is secured by a network of computers that are going to be verifying all of these transactions. Certainly, cryptocurrencies don't have any physical bills or coins. That's another thing that's going to differentiate it from other currencies. And in terms of how you can use it, real currencies, so to speak, fiat currencies are acceptable anywhere as long as you are within that country that happens to issue it. And if you're lucky enough to hold US dollars, well, there are some other countries out there that will accept it. For crypto, it's a little bit different. But staying on this page, right, and thinking a little bit deeper, if we think about what traditionally defines a currency, there have to be two situations, circumstances that are fulfilled before you can really call something a currency, at least when you're thinking about it from an economic perspective, right? If you were to open up the economics textbook and read about what makes for a currency, there are two big things that must be satisfied. The first one is that a real currency, an effective currency, has to be an effective store of value. The second is that that currency has to be an effective medium of exchange. Those are the two things that you really look at when you're trying to figure out what really defines a cryptocurrency. Now let's take the dollar as an example. How is it as a store of value? Well, very clearly, there's been a whole lot of discussion about inflation recently, and for good reason. It wasn't too long ago that inflation was running at a 4-decade high. People concerned about the value of the US dollar. But let's sort of zoom out a little bit on that and pretend for a second that you went to the bank and you took $10,000 out of the bank from the ATM or from the teller or wherever it may be, and you stuffed it under your mattress. And then you came back a year later. That $10,000 that you put in today would be able to purchase more or less the same amount of goods or services next year. Certainly, inflation may erode a bit at that, 2, 3, 4%, in extremes upwards of 10%. Maybe you used to be able to buy 10 televisions and now you can only buy 9 televisions, whatever that metric is that you want to look at. But generally speaking, the US dollar holds its value very well, and it is predictable in its ability to store its value. It's not going to wildly fluctuate day in and day out. Changes to price will happen over time. Cryptocurrencies, by contrast, are not quite as stable in terms of its ability to hold value. Take Bitcoin, for example, which fluctuates wildly. In fact, is up 200% this year alone, after falling by more than 50% from its peaks at the beginning of 2021. If you were to put 10,000 US dollars into a cryptocurrency and revisit it a year later, maybe it's worth $1 million, maybe it's worth absolutely nothing. And then everything in between is equally as viable, except for being worth about 10,000 US dollars a year down the line. So cryptocurrencies, at least right now, are not particularly effective stores of value. Now, how about mediums of exchange? Well, in that case, the dollar is a very good medium of exchange. You can walk into any store across the United States, and again, as I mentioned, in certain countries outside of the US, and exchange your greenbacks, your cold, hard, physical US dollars, for a good or a service. That is not the same as what you're looking at with cryptocurrencies. Only a very small handful of companies actually accept crypto as a medium of exchange, as a way to pay for a certain good or a service. Crypto is not an effective medium of exchange by expanding that logic there, right? You cannot walk into Starbucks and buy a latte with your Bitcoin. And so cryptocurrency right now, not really satisfying either of those two major demands of what makes for a currency, is not really a currency, right? It wants to be, and that's how a lot of people think of it as, but it is not actually a currency, at least if you think about it from that economic perspective. It's not an effective store of value. It is not an effective medium of exchange. Instead, cryptocurrencies, which is a misnomer, but we're going to keep calling them that because that's how everybody refers to them. Instead, cryptocurrencies are assets. But unlike other assets, like stocks or bonds that have an income stream through dividends or coupons, or even commodities like gold, oil, lumber, food that have practical real-world applications, the only thing you can really hope for from most cryptocurrencies is that some other person out there is willing to pay more for that token that you own than what you paid for it yourself. That is the assumption behind a lot of asset price movements in the cryptocurrency space. So not so much a currency, much more an asset. With that as an understood and under our belt, so to speak, let's turn to the next page here and talk about the other facet of the crypto world, which is the blockchain. A very exciting and mysterious term, right, that gets tossed around a whole lot. Even the people that are naysayers about cryptocurrency will tell you, well, hey, no, the real value's in the blockchain. But what is the blockchain, right? How do we define that? Very simply, the blockchain is going to be a database, and a database is a collection of information that is stored electronically. Now, we can think about something as simple as a spreadsheet, right? Microsoft Excel, that's a database. It is data organized in rows and columns, building a table. The difference is that blockchain organizes its data into what they call blocks, which are then chained together, right? This is not a physical thing. It's going to be out there in the universe, in the ether, so to speak. But this is not practically the same as a table, although functionally it gets you to the same place. A blockchain, at the end of the day, is a database. It's infrastructure. And you want to put this very simply, All blockchains are databases, not all databases are blockchains. Now, in terms of how you can actually use blockchains, right now, they are primarily used to store cryptocurrency transactions. So if I wanted to buy or sell something with a cryptocurrency, if I want to exchange a cryptocurrency with another individual or a business for whatever reason, that transfer of the cryptocurrency will be logged in the blockchain, and the blockchain will support and store that transaction. But what's more exciting about the blockchain is all the other stuff that it can be used for storing other information as well. Now, if we look at the next page here, we can figure out exactly what some of those applications may actually be. Here are a handful of examples of what the blockchain can do to improve things like efficiencies in different lines of business. On the financials side of things, we could use the blockchain to disintermediate financial markets, to create a decentralized financial network. Some benefits of a blockchain-run financial network: anonymity, extended operating hours, so 24/7. Blockchain doesn't care about holidays, doesn't care about weekends, doesn't care about 5 o'clock on Fridays, and also less exposure to political instability, protection from human error. Let's look at something like healthcare, right? We have this health intermediary exchange providing a little bit more of a secure method for storing healthcare data. Another interesting example is what you see in logistics and supply chain problems. I don't know if anybody remembers several years back when there was an E. coli outbreak at Chipotle. And it took them years, it took them months and months and months to figure out exactly what that outbreak came from, right? Because they have all these different farms, all these different supply sources. No one's quite sure where the bad lettuce came from. Well, believe it or not, you could store that supply chain. You could store that information, that data about where all those materials came from on the blockchain, have it be verifiable, have it be traceable. And this one particular store where the outbreak started could actually look back in time at exactly where their lettuce was coming from and isolate precisely that farm that was contaminated with E. coli and shut it down. So you have some real world implications that you're already starting to see play out. Walmart has its own blockchain. JP Morgan, in fact, has its own blockchain. All of these different sectors and industries that can benefit directly from this blockchain technology. Now, when we think about sort of the investment implications of cryptocurrency and blockchain, I think the first thing that probably comes to mind, if we look at the next page here, is going to be Bitcoin, right? There is a whole lot of discussion around Bitcoin. Why are we spending so much time talking about Bitcoin? Well, I'd say it's a couple of reasons, right? And this is obviously outside of even the news with FTX and Sam Bankman-Fried getting sentenced to 100+ years in prison. Bitcoin is an irresistible ride to watch, right? It's kind of like a train wreck in that sense. The price here has fluctuated wildly. As of market close just a few weeks ago, or about a week ago at this point, the cost of a single Bitcoin in US dollars was around 35,000. That is double where it was at the start of the year, but around half of where it peaked at the beginning to middle of 2021. This whipsaw of volatility keeps Bitcoin in the news, right? You spend a whole lot of time talking about it because it's up 5%, it's down 10%, it's up 20%, it's down 50%. It's not like the stock market or bond market, which comparatively are a whole lot more calm and a whole lot less volatile. This is a really rocky, wild ride, and people just can't get enough. The other reason we spend a lot of time talking about Bitcoin from this perspective is that a lot of us see it as a get-rich-quick instrument. Look at where Bitcoin was trading in 2020. Look at where Bitcoin was trading at the beginning of 2021. There is no other asset out there where you can 7x your money in 12 months. Think about where Bitcoin was trading less than 10 years ago in 2016. You could have put $10,000 into Bitcoin and perhaps been a billionaire a couple of years ago. You cannot find those returns anywhere else. And I think that this excitement that gets trapped up in this idea of getting rich very, very quickly encourages a lot of interest in the asset, right? A lot of people want to get rich very quickly. My best friend, truly, made a whole lot of money in crypto out of pure dumb luck. He started investing in it, quote unquote, back in 2011, 2012, and he turned, $10,000, $20,000 into $2 million in a pretty short period of time with absolutely no work done whatsoever. Believe me, I'm very jealous about his success, although I'm very happy for him as well, right? So this crypto saga has been extraordinary because of the volatility that you've seen in Bitcoin prices and the ability, or at least the perceived ability, to get really rich really quickly through cryptocurrencies. If you look at the next page here, the other reason that we spend so much time talking about Bitcoin in particular is that Bitcoin is the biggest cryptocurrency in the crypto universe. We show market capitalization here of Bitcoin relative to the broader crypto market. As of about a week ago, Bitcoin represents just over a half of the overall crypto market. Now, that's higher than where it was a year ago. It is lower than where it peaked, which was at one point closer to 90%, but this is still the single largest token out there. Everything else, by extension, is a whole lot smaller. So not only is Bitcoin very volatile, price is whipsawing all over the place, but it's also the biggest, most influential coin in the space. That's why we spend so much time talking about Bitcoin. And if we look at the next page here, we can start to figure out a little bit of what Bitcoin actually is. Put very simply, the Bitcoin ecosystem is going to be a group of computers that run Bitcoin's code and store Bitcoin's blockchains. Now, there's a lot of technical information on this slide we don't really need to get into, but there are a few things that are important to remember about Bitcoin. Bitcoin, first of all, is released into circulation through a process called mining. And mining means essentially that people are solving very, very complicated puzzles, algorithms, and in doing so, being rewarded for that computational power with the creation of a new Bitcoin. When Bitcoin is trading at $70,000 a coin, it can be extremely lucrative to be a Bitcoin miner. It's why all of these individuals went out and bought all these supercomputers, why it became very, very hard to get a hold of some of these high capacity semiconductors. They were driven by Bitcoin frenzy when Bitcoin was trading at $70,000 a coin, and there was all this money to be made in mining. Now, that mining process happens through what is called a proof of work process, which means that you actually have to go out there and solve whatever this equation may be, and then prove that you have solved it. That requires an enormous amount of computational power, a whole lot of energy, and in fact, Bitcoin's mining process has raised some environmental concerns. Bitcoin as an instrument consumes more energy than some countries do in a year. So not particularly environmentally conscious or friendly in a world where we are paying a whole lot more attention to sustainability, one of the marks that we've seen against Bitcoin. But the other really important thing to remember about Bitcoin is that there will only ever be 21 million Bitcoin. There is a finite amount of Bitcoin. On May 11th, 2020, so a little over 3 years ago, the third halving occurred. Now every block that is created is rewarded with 6.25 Bitcoin. Again, that could be upwards of $500,000, depending on where Bitcoin is trading. Another halving will occur a few years from now, and eventually we're going to stop making Bitcoin. This is extraordinarily appealing to individuals that want to use Bitcoin as an alternative to the US dollar. A lot of people feel like when the US dollar abandoned the gold currency, when the US government, when other governments abandoned their respective gold standards, that the value of money has essentially become meaningless. Bitcoin hopes to kind of bring currencies back to being tied to something tangible, something scarce. And that's what makes Bitcoin so appealing as a potential currency, especially as a currency alternative to what you may see with the dollar. The scarcity there is extremely important. But since Bitcoin right now is not a particularly effective medium of exchange, right? Because you cannot go into a Starbucks and buy a latte with a Bitcoin. We have to think about some of the other ways that Bitcoin can play a role in a portfolio. And the next page here, I think, helps to talk a little bit about this. The first one is that Bitcoin, I think we went one too many, but that's okay. The first one is that Bitcoin is not a particularly highly correlated asset to anything, right? On this page, we show Bitcoin's correlation to risk assets. So the green line representing when Bitcoin moves alongside the S&P 500, the blue line representing what happens when Bitcoin moves alongside inflation expectations. Looking at the next page, we chart out the correlation of Bitcoin against defensive assets. So the Bitcoin moving against the bond market, here represented by the Bloomberg US aggregate, and moving against gold. Now, what you can see on both of these pages is that correlations do not hold steady and flip polarities, it feels like, every 2 to 3 years. Sometimes Bitcoin is positively correlated to gold. Sometimes it is positively correlated to bonds. Sometimes it's positively correlated to stocks. Sometimes it's positively correlated to inflation. And sometimes it's negatively correlated to all of those things. In a world where correlations feel like they've broken down, remember, stocks and bonds both moving in the same direction in 2022 at a time when you needed something to help to keep your portfolio afloat, the lack of correlation and stable correlation to any one particular asset, whether it is a risky asset or a defensive asset, is appealing about Bitcoin. So when we think about it as an investment opportunity, it actually can be a pretty decent diversifier in a portfolio. That thing that has the potential to zig when everything else is zagging. I'm not saying, allocate 10, 20, 30% of your portfolio to Bitcoin, but we have actually heard of clients allocating 1 or 2% of their net worth to a cryptocurrency like Bitcoin to sort of help to smooth out the journey, right? Whether that's worked in the last couple of years, I think, is certainly debatable. But very clearly, if you look back over the last decade, the lack of stable correlation can be appealing for Bitcoin as a diversifying asset in a portfolio. But we also have to remember, right, that beyond Bitcoin, there is a whole other ecosystem out there. And if we look at the next page here, that is generally speaking going to be something called Ethereum. Again, a lot of technical information on this page, Ether being another cryptocurrency running on the Ethereum blockchain. But what differentiates Ether and Ethereum more broadly from Bitcoin is two big things, with a third that's kind of on the margin. The first one is that unlike Bitcoin, which is really only good for decentralized payment networks, and even then it's not particularly good because, again, it's not an effective medium of exchange, nor is it an effective store of value, Ethereum can be used to power decentralized payment networks, but also store code to power contracts and applications like some of those things that I mentioned earlier on the blockchain page, right? Thinking about how supermarkets could use could use blockchain, how healthcare could use blockchain. That stuff would be powered not through the Bitcoin ecosystem, but through the Ethereum ecosystem. The other major key differentiator of Ethereum is that the supply of Ether is not capped. There is no finite amount of Ether in the same way that there is a finite amount of Bitcoin. Nobody is trying to replace fiat currency with Ethereum. Instead, we have to think about Ethereum more as infrastructure and less as a currency, in the sense that it can support the investment in all of these different little productivity enhancing initiatives. And from that perspective, Ethereum is actually quite interesting. If you think about it as investing not in the token, not in a currency, but as infrastructure that has the potential to fundamentally transform certain business models. Thinking about how healthcare may change, thinking about how financial services may change, thinking about how retail may change, taking advantage of blockchain technologies. Now, as I mentioned earlier, right, JP Morgan, Walmart, two very large companies that have actually built their own blockchains based off of the Ethereum infrastructure. You cannot buy JPM coin, right? That's an internal infrastructure in the same way as we use the internet and things like that. But what happens if you are not a multinational, multi-trillion-dollar company with hundreds of thousands of employees all around the world, and you still want to take advantage of some of these efficiency gains that can be provided to you by blockchain? Well, that's when you go to the Ether network, and you buy these individual tokens which support individual infrastructure changes. And if you own the token, all of a sudden you own the infrastructure, or at least a part of it. So now we can think about cryptocurrencies, this world of crypto, as not just a diversifying asset, which Bitcoin does quite nicely, but also as almost a ground floor investment in transformational infrastructure. The caveat here, though, right, is that there is just an absolute ton of creative destruction in this space. The barriers to entry are very, very low. Anyone can create a new token. And if they create a new token tomorrow that is better than the one that was created today, there is nothing that will guarantee that what's created today will still exist tomorrow. That's this concept, right, of creative destruction. And so if you are going to invest in Ethereum, thinking of it not again as a currency, but as sort of an infrastructure investment, recognize first of all that anything that you own can go to zero very, very quickly. We are not talking about anything nearly as stable as stocks. Forget about being as stable as bonds, right? The value of your Ethereum investment can be neutralized overnight if something new and better comes around. But the other thing, sort of to build off of that, right, is that if you are to invest in the Ethereum infrastructure and buy a handful of these other tokens out there, you don't want to own one or two or three. You want to approach this almost like you're approaching mutual fund investing. Own 5, 10, 20, 100. And that way, if one or two of them get wiped out, put out to pasture by something newer and better that shows up, your portfolio itself does not get wiped out either. So when we think about investing in the crypto space, we have to put aside the currency component, at least for right now, and hone in on crypto's ability to not just be that diversifying asset, but also to be that transformational infrastructure. So the question now, if we look at the next page here, is, well, what's next in the crypto space? One of the biggest things out there is increased institutional engagement and adoption. Not just individuals out there speculatively buying Bitcoins, but pension funds, insurance companies, asset managers, banks, the big players out there getting into the crypto space. And it's hard to visualize the increased demand for cryptocurrency from institutions. I don't know about the rest of you dialed in right now, but I know at least on my end, I've been seeing nonstop ads on TV at airports for GBTC, the new Bitcoin trust that exists out there. That's got to be evidence of something, right? That there's a lot more demand out there for this product. We've decided instead to reflect it in terms of open interest for futures for Bitcoin across different exchanges. Now that's kind of complicated, right? But we're talking about the futures market, which is itself a derivatives market. And it means because it is open interest in this stuff, these are trades or claims that are not settled immediately. They're left open and they wait to mature. Now, the number one facility exchange for open interest in Bitcoin futures is going to be Binance. Binance is an offshore, unregulated crypto exchange, 24/7, not run or regulated by the US government. It is very much the Wild West, and it is the biggest player out there. But number two, and a very close number two, rising very, very quickly over the last couple of years, has been CME, which used to stand for the Chicago Mercantile Exchange. CME is the largest derivatives market on the planet. It is where you trade currencies. It's where you trade commodities. And now it is where you trade cryptocurrencies, right? CME as a place to put interest or to invest in cryptocurrencies has risen dramatically. And unlike Binance, it is regulated and it's a whole lot more legitimate. The fact that CME has risen to become this massive player in the crypto space is evidence of increased institutional adoption and interest in this asset class. And as institutions become more and more interested, the asset class becomes more and more legitimized, and the opportunity set increases. In other words, this stuff is not going away anytime soon. But if we look at the next page here, the other way to think about what's next for cryptocurrencies is how central banks and governments around the world will approach their own version of digital currencies. Now, a central bank digital currency, or a CBDC, is not a cryptocurrency, right? Sort of by definition, it is not a crypto asset because it is centralized and managed by a governing authority. But it is a digital asset, which is going to be very different from, say, traditional fiat currency like the dollars that you may have in your wallet or in your bank account. We show on the right-hand side an interesting evolution of adoption when it comes to various phases of central banks and countries exploring their own version of digital currencies. We can see that 130 countries representing 98% of global GDP are currently exploring a CBDC. In April of 2021, we were looking at 24% of these being pilots, with only 1% of them being launched. Now we are looking at 16% of them being pilots, but 8% of them being launched, and a whole lot more of them in the pipeline, represented by that gray slice of the pie. There are a few benefits to governments of cryptocurrencies, or rather digital currencies. One of them is that there is, in theory, a lot more stability and more security in the ability to store this information. The other thing that is nice for end consumers is that you don't need a bank account to actually have access to currency. In the US, about 5% of individuals don't have bank accounts. In emerging countries, that number is a whole lot higher, right? So you no longer have to have a relationship with the financial institution to have access to money to be able to go out and buy things. The downside to central bank digital currencies or government-backed digital currencies is that they are very easy to track, which means if you are trying to do deals under the table, if you're trying to evade taxes from the government, it becomes a whole lot more complicated. The other downside, right, is that the government now has a view into what you are doing, and in theory has control over your money supply in the way that if you were purely exchanging in physical dollars or whatever your currency may be, you are not necessarily at the same risk. Now, China has been rolling out something very similar to this. They call it ECNY. It was kind of debuted and showed off at the 2022 Olympics. We actually had people able to kind of wander around the Olympic Village and pay for things with their ECNY without having an actual bank account. That is still in trial mode, but could get rolled out soon. Functionally, not a whole lot different than the actual currency, right? Than using your Apple Pay to pay with a credit card or a debit card or whatever. But the infrastructure is going to be quite different. Also interesting is that China has outlawed cryptocurrency ownership. So this is as close as Chinese citizens will be getting to digital currencies anytime soon. We also know that the US is starting to explore the idea of a central bank digital currency. President Biden, about 2 years ago, signed an executive order authorizing the Federal Reserve to look into this stuff. The Fed, as of right now, has not launched a digital currency, and in fact cannot launch a digital currency without an act of Congress. And so there's nothing immediately on the pipeline right now. But we do see the Fed getting more into the payment space and trying to mimic some of the benefits that you see from something like blockchain technology with a program called Fed Now that was rolled out earlier this year. That is a payment infrastructure that allows eligible financial institutions to instantly transfer funds. So again, right, 24/7 access to your money. You don't have to worry about holidays. You don't have to worry about weekends. You don't have to worry about 5 p.m. on Fridays. Fed Now is free to use and allows for that instant transfer of assets, which in theory smooths out the financial system and makes things more efficient. It also means that the Fed pays more attention to how you're spending your money and has more control over the money that you are spending. Not something that everybody is particularly keen on. But central bank digital currencies, in addition to increased institutional adoption, are the two big things we have to pay attention to looking forward if we want to have a view on what's happening with the crypto space. All of this is to say, right, that while this stuff can certainly be chaotic and controversial, and it clearly is not for everybody, even with the bad headlines recently and the downward pressure on prices last year, this stuff is not going anywhere anytime soon. And so having some sort of view on crypto and the opportunities and risks associated with it is critical for future financial planning and asset management. So with that, Emily, I think I'd like to pass things back over to you, and happy to open things up for questions.
Thank you, Jack.
You're welcome.
Very good information, lots of it. We did have some questions come in, so I will run those by you. I want to start first, just continuing the conversation on the central bank digital currencies.
Yeah.
Do you think that the central bank digital currencies pose a threat to the US dollar?
So I wouldn't think about it that way, because a central bank digital currency in the United States would be issued by Treasury and would effectively be a clone of the US dollar. It's not going to be two parallel currency structures in the United States. It's still going to be the dollar. It's just going to be a different way to access it. Because at the end of the day, it's still not going to be tied to anything, right? Current fiat currency is not tied to anything. Any sort of EUSD will similarly not be tied to anything. It's just going to expand this sort of access to currency that individuals, particularly those that don't have bank accounts, will have. So I wouldn't think of a central bank digital currency as threatening the supremacy of the dollar. Bitcoin, in theory, could threaten the supremacy of the dollar because it is disintermediated. It has nothing to do with any sort of government. It is unregulated. But given some of the issues that I was talking about earlier, I don't see Bitcoin replacing the dollar anytime soon. It's just simply too volatile. And the bigger it gets and the more important it gets and the more people use it, the more keen that government authorities will be to regulate it. And then when they regulate it, the use case, I think, decreases. So I wouldn't worry too much about any of these replacing the US dollar as a reserve currency anytime soon.
Okay, interesting, good. What are your thoughts on the introduction of a Bitcoin ETF?
Well, I don't get it, honestly. I guess the nice thing is that at least I bank at Chase, right? So I work at JP Morgan, so it makes sense, but I bank at Chase. And I know that on like the Chase brokerage platform, right, I cannot buy Bitcoin. I cannot buy Ethereum. I actually do have a Coinbase account on my phone that I created and bought, a little bit of some of these things a couple of years ago. Spectacularly bad decision, by the way. I basically lost half my money in like a week and a half. But I wanted to, I wanted to be able to like eat my own cooking on this, and I'm doing more work on crypto. So hey, I should have a stake, and a horse in the race. But I couldn't buy those things directly through. My brokerage platform. I had to buy them through a separate exchange. The nice thing about a Bitcoin ETF is that you will likely be able to buy these things on brokerage platforms, because then they will be traded on exchanges in the same way that stocks and funds are in some cases traded. But why do that when you can buy through another sort of exchange? I guess some of that has to do with security and stability. I suppose I trust the infrastructure, the security apparatus at Chase or any of the big brokerages around the country more than I would say Coinbase. Who knows who's hacking into that stuff? But really, when I think about something like crypto, Bitcoin, whatever, I think you can draw a parallel there to gold. Where if you want to be a gold investor, are you going to go out there and buy a bar of gold, or are you going to buy like a synthetic ownership of gold that is stored somewhere in a vault, halfway around the world? I think most people would rather buy and hold the physical asset. That's half the appeal of actually owning this thing. So maybe Bitcoin ETFs open up the opportunity set. They decrease volatility because there's more volume being traded, makes it easier to get a hold of on more stable and verifiable exchanges. But I think from a true pure value perspective, there's no good reason to buy it through an exchange traded fund as opposed to buying it directly from an issuer or from one of these exchanges.
Okay, thank you. A question here, do other cryptocurrencies other than Bitcoin have limited issues or finite amounts?
Bitcoin is going to be the only one worth talking about that is capped, because Bitcoin is truly trying to be an alternative currency and is linking its value its inherent value to its inherent scarcity. All the other stuff is basically should be thought of as like a fork. Bitcoin went this way, everything else went this way. Over here, I'm like fading in and out with my stupid fake background. Over here is going to be Ethereum and that infrastructure. So I think it really helps to inform you like the view on what this stuff is meant for. The scarcity of Bitcoin means that it's meant to be a currency replacement. The lack of scarcity for Ethereum and the other coins associated with the Ethereum ecosystem are proof that it's meant to be much more of an infrastructure than a replacement for any sort of currency that you may transact in.
That's a good qualification. I hadn't thought of it that way. Good. So not to piggyback on that, another question came through. How do you wade through the options available? There's just cryptocurrencies galore if you try to go on to Coinbase or wherever you're going.
Yeah, I don't really have a good answer to that because it is overwhelming. I would tell you I would not like go on to Reddit and see whatever the top trending coin is. Similarly, I would not go on to CNBC and see what, Jim Cramer is screaming at you about. Like, I don't think you want to rely on big whales in the space to pump up the value of one particular coin on social media or on television or whatever it may be. That feels like a dangerous way to approach this. There is plenty of research out there. You can read actually on some of these exchanges kind of white papers that are published for each one of these coins and learn a little bit more about what they actually are. But I would guess, and this is a very interesting question because it proves that this industry is very much in flux, that give it 5 years when institutional adoption has increased and you can now access these cryptocurrencies through funds like Emily, what you were talking about, that you are going to start to see something that feels a whole lot more like a mutual fund managed by a professional money manager, where instead of buying individual stocks of companies, you are buying a handful of cryptocurrencies that are supportive of a particular trend. So you're going to buy a fund that owns 100 different cryptocurrencies that are all trying to do something to revolutionize financial services, or revolutionize the healthcare space, or revolutionize energy, right? And so you'll approach it almost thematically when it comes to that investment opportunity. But right now, nothing like that actually exists. So it is very much a buyer beware type situation. That's why I mentioned sort of towards the end of the presentation, you got to be aware that whatever you buy right now can go up in smoke very, very quickly.
Very good. What are your sources of information when you're looking into current events around cryptocurrencies?
Yeah, so McKinsey actually put out a really interesting thought piece on central bank digital currencies earlier this year. It's a really good and pretty straightforward read because they're management consultants, so they're not trying to make things overly complicated. It's also free to view, which is nice. Just a PDF on Google. You don't necessarily have to dig into it or pay very much to dig into it. Other than that, it's frankly whatever's hitting the headlines. And I'll tell you, I know when crypto is going up because that's when I start to get questions about it, right? Or I know when crypto is going down because that's when I start to get questions about it. When nothing is happening, no one wants to talk about it. That's just the way this is. It's not like stocks or bonds or the Fed where there's always something to say. With crypto, it is very cyclical. It's very much feast or famine. Either it's all anybody wants to talk about or no one wants to talk about it at all. And the frequency of those conversations kind of inspires me to go out and proactively do some research and seek things out. So it's not like, I open up Crypto Daily every morning and kind of read about what's going on. It's a made up publication, by the way. I'm just for dramatic effect, right? I'm not opening up some sort of publication every morning and learning about the crypto space. It's very much in response to increased demand. I'll get a question. I'll think, oh, that's interesting. I'll go out and do a little bit of research and kind of add it to the bank. But that McKinsey piece is super interesting, particularly as it relates to digital central banks or central bank digital currencies. And I would definitely encourage anybody that's interested in that space to read a little bit more on that front.
Great, good resource. We'll look into that. We did get a few questions related to whether our Schwab, who we custody through, allows for direct investing in cryptocurrency. Not a question for you, Jack. Just wanted to share that direct investing into cryptocurrency is not currently available through Schwab, but there are several indirect ways to get exposure, and that's typically through stocks that have involvement in the digital asset or through an ETF. Once there's more regulatory clarity, Schwab will likely have more investment options available for clients. that concludes the questions that we had. Any closing thoughts in terms of what to look for in the near term, Jack, before we close out?
Not so much, Emily, in terms of what to think for or what to look at in the near term, other than whatever happens with Sam Bankman-Fried over the next few months. That will certainly be very interesting. I would just remember, and I should have mentioned this earlier, but I'll mention it now, that you can approach the world of crypto a lot of different ways. You can buy and hold the I don't want to say physical asset, because there is no physical asset, but you can buy and hold the tokens themselves, or you can buy the ancillary businesses that either support those tokens or benefit from those tokens. So what I mean by that is, right, there are companies out there, their whole purpose is to build blockchains, right? Because like I said, JP Morgan's got one. We hired a bunch of, people out of Stanford, I'm sure, moved them to the New York office and had them build us a blockchain. But if you can't do that, you can hire a firm that will then go out and build a blockchain for you. So there are companies out there that actually build out the infrastructure. You can invest in those. You can invest in the companies that build the machines that power Bitcoin mining. The computers, the semiconductors, all the stuff that goes into the equipment that goes into Bitcoin mining, Bitcoin production. You can invest in those companies and kind of benefit from the ebbs and flows that exist within the crypto space. On the other side of that, there are companies out there that are benefiting from the blockchain, right? I don't know what they are because I'm not a securities analyst. That's a job for a portfolio manager. But I mentioned places like JP Morgan, Walmart, right? Two very large institutions that are benefiting from the blockchain. Look to companies that are talking about the blockchain in their earnings reports, right? And how they are using blockchain technology to improve efficiencies, which in turn translates into heightened earnings generation ability, right? And so you can invest in companies that are leveraging the blockchain to become more profitable and thereby benefit from this shift without, again, directly owning the token. So if you want to get your feet wet, but you don't want to go all in and open up a Coinbase account and start buying this stuff without any sort of real clarity, you can kind of step in a little bit and buy some of these ancillary businesses that help to support or are supported by cryptocurrency and blockchain technology.
Wonderful. Well, thank you so much. On behalf of Evans Maywell and our clients, we appreciate you sharing all of this information. To all of those that have joined us today, we hope you found value in Jack's insights. What an exciting topic that's sure to keep us on our toes.
Thank you all very much.
Thank you for joining us. Good evening.